Good afternoon, everyone, and welcome to another session of Unlock the Stock. We are very pleased to welcome today TWK back to the platform, and they are represented by Andre Marburg, the CEO, and Eddie Favas, the CFO, who will take you through the presentation shortly. This Unlock the Stock platform is specifically designed for retail investors to gain access to corporate management and to get to know them and their businesses just a little bit better. As you know by now, Unlock the Stock is only possible due to our technology partner Lumi Global, and you can visit their website at lumiglobal.com to learn more about Lumi's various online AGM and investor presentation solutions. Our hosts will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A session. This event is sponsored by A2X, a stock exchange that plays an integral part in the progression of the South African financial markets. A2X is the second largest stock exchange in Africa, if measured by market capitalization, with 183 securities listed on the platform, including 31 top 40 stocks, with a current combined market capitalization of 8.7 trillion rand. The team at A2X is proud to be partnering with Unlock the Stock. Just as our platform unlocks value through insights and analysis, A2X unlocks value for stocks listed on its platform, helping to drive the markets forward. Before we start, there are just a few housekeeping notes. Andre and Eddie will take you through the presentation, which will be followed by a Q&A session. Please note that you will only be able to post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel. You will see an email address at the beginning of the Q&A session, and if you'd like to be added to TWK's distribution list, please will you send an email to that address. Andre and Eddie, we are ready for you to share your presentation and to take us through it, please.
Welcome to everybody, and thank you for attending this presentation of TWK on our 23 results. It's my pleasure to welcome you here, and I hope that you can learn a bit more about TWK and also invest a bit more in TWK. I think just for the people that don't know TWK that well at this stage, TWK Investment is listed on the Cape Town Stock Exchange, and we also have a secondary listing on A2X. The TWK Group, TWK is a diversified agricultural group of companies, and we operate in the segments of, first of all, timber. We have our own plantations, and we also buy timber from our farmers, and we supply that timber to local as well as international customers. Then we also have our segment of the retail and mechanization. That also includes our fertilizer business. We have about 31 retail stores and about 5 fertilizer plants, blending plants, where we blend fertilizer. On the financial services side segment, we have our insurance department, and then also the debtor side, where we are on-lend financing our farmers for their inputs on the production side. Then we have our segment of grain. We market grain. It's a part of where we market our farmers' product. And then we also have manufacturing, where we have our own branded maize and animal feeds. And we also have silos where we have storage. The motor segment is not part of the slide anymore. The motor segment has been classified as discontinued operations and has been held as assets for sale. Just a quick glance at our financials. Mr. Favas would go through the financial just now, but just an overview of it. On the revenue side, we're up 5% to 9.7 billion. On the EBITDA, we have decreased of 7% to 621 million. In the profit after tax, we have a decrease of 31% to 249.7 million. Basic headline earnings per share, we're also down 37% to 549.5 cents. I'll give a little bit of background of what the reasons is for the profits that's a little bit down. Then also on the net asset value per share, it's up 9% to 57.16 rand. Cash from operating activities after working capital has a good increase of 82% to 673.1 million. If you look at the year, for us the year was actually in two halves. The first half was a solid set of results, mainly due to the outstanding performance of our timber segment. The second half, however, the results impacted by challenging environment and high levels of cost inflation. That challenging environment is mostly the decrease in commodity prices that had a big influence on our profitability. But I think it's also important that I mention here that the diversifying of the company's income streams provides some resilience to this. The decline in results for the year 2023 was mainly due to severe pressure on profits in the retail and mechanization segment as a result of the financial performance of Constantia Fertilizer. Constantia Fertilizer, if you're looking at the previous year, we have performed quite well because of the increase in the commodity prices of fertilizer, and this year it have come down quite sharply. The fertilizer price have decreased about 50% from where it were, and we have a little bit of a double whammy, the fact that the farmers have spent a bit less and buy a little bit less volumes, and also they have postponed their buying last year, so hopefully we can get some more volumes out this year. So it was a little bit of a double whammy that we have on Constantia, and if you are behind the curve of a downtrend, then it's very difficult to make money in that segment. But it was offset by the growth in our wood chip export and local timber sales, and there was an increase in our exports. We had about 634,000 tons that we exported last year. This year we have about 684,000 tons that we exported. It is an increase, but at the beginning of the year we were very optimistic and we think we had going to be much better. We have orders for around about almost 900,000 tons, but the second half, after China's downturn in the economy on that side, they have cancelled all their contracts, but still we couldn't export that to China, so we lost that sales, but still we have better sales than the previous year, and it helped us a lot. Also the forex, the rand that was weakened, that also was good for us on the export side. Then also good growth across all financial services businesses, and especially here the insurance part of the financial services performed quite well. Also improvement in results from our grain business as well. So if you look at that, you'll see, if you have the previous slide still in your head, that all of the segments has actually performed better than the previous year. It's only our segment of retail and mechanization that didn't perform that well this year. But luckily we could offset that from the other segments. There was also a decision after our yearly strategic session. There was a decision that we reached to sell the motor segment, hence being classified as discontinued operations and asset held for sale. Every year we look at all the businesses, and we once again look at the motor segment also, and decided it's not forming part of our core business, and that we can utilize the capital that's invested there better in the value chain of one of our core businesses, and to have better returns on capital invested. If I can just summarize it, for the past year, the group's financial position remains solid with a strong cash generation during the year. I'm going to hand over to my colleague, Mr. Fives, to give you a bit of an overview of our financial performance of the company as well as every segment itself. Thank you, Eddie.
Thank you, Andre. Also from my side, warm welcome and thanks for attending this session. Before I go into the detail of the results, I first want to touch a little bit more on the driving factors behind the results of 2023. I think it goes without saying that we are definitely not satisfied with the results of the past year. The results is definitely not a reflection of the underlying value of the TWK group. The last 13 years, we've reported record results with outstanding year-on-year growth. This year, profit before tax actually decreased approximately by 18%, compared by the record increase of 30% in 2022. Andre mentioned that the year can be categorized as two halves. I like to categorize it as a half full glass, because there was negatives, but also definitely some positive aspects as well. The first part was filled with outstanding performance, especially by the timber segment. This was despite a decline in the exports to China, as Andre already mentioned. This result really reflects the competitive advantage of our timber segment and also the positive contribution that the recent acquisitions that we have made in the timber segment. I'm specifically talking now about the big timber assets that we acquired. However, the results were impacted by a lag in recovery and unexpected levels of cost inflation, as well as global and local supply chain challenges and margin pressure in the fertilizer business unit, as the prices constantly declined, as Andre mentioned and explained. However, resilience and also innovation is part of our core values. With that in mind, market penetration, disciplined cost control, the improvement of operational efficiencies, investment in strategic business opportunities, and also the sale of non-performing assets was top priority during this difficult year. The funds realized from selling these assets will be utilized to expand in strategic business opportunities. One of the key factors for TWK is to create sustainable shareholder value. We are therefore constantly looking for expansion opportunities and are already in advanced negotiation stages in a couple of promising opportunities to enhance our profitability for the new year and going forward on a sustainable basis. If we can look then at the key financial indicators. First, revenue. For the last 5 years, we have achieved year-on-year growth, especially the 9% increase in the 2022 financial year. That was driven by market penetration and also the additions, the strategic additions. In the 2023 year, growth of revenue 5%, and that was notwithstanding a decrease in revenue from the retail segment. If we look at EBITDA, the EBITDA decreased by 7% in 2023 from the 669 million to 621 million. That was impacted by a decrease of 78% in the EBITDA from the trade segment, but it was supported by the timber segment and also disciplined cost control and also efficiencies. If we look at profit after tax, also good year-on-year growth, except for the 2020 year, the COVID year. In the 2023 year, down by 31% in terms of profit after tax. That was impacted by margin pressure in the fertilizer business, fuel price increases, inflation, and also interest rates hikes. If we look at basic earnings per share, down by 37%. to 550 from 876 cents. All of the above really translated into the decrease in headline earnings per share. We continue with the financial indicators. Total equity for the last 5 years, also consistent growth. The last year, 2023 year, an increase in 10% to just over the 2.1 billion rand. Net asset value per share increased by 9% to 57.16 rand. Constant focus on our gearing ratio. The gearing ratio decreased further during the last year and at year end stood at 118.9%. Share statistics, also good performance from our share price the last couple of years, especially since listing. At year end, the share price was at 50.50 rand, and it was really driven by the market updates since February that TWK will not be in the same financial position than the previous financial year. We've declared a dividend post year end of 1.15 rand compared to the 1.50 rand the previous financial year, and this still represents a 5-year compound annual growth rate of 8.9%. That represents then a dividend cover based on headline earnings per share of 4.8 times. We quickly look at the cash flow movement. At the beginning of the year, we've started with cash surplus of 214.6 million rand. Positive inflow from cash from operating activities of 31.7 million. We've invested in additional inventory, so an outflow of 164.1 million. That is to be ready for the new financial year, especially for the demands in terms of our export markets and also the recovery in the fertilizer business. Biological assets harvested an inflow of almost 200 million, and creditors decrease, positive inflow of 79 million. We've paid taxes of 61.6 million, finance costs paid 267 million, and net purchases of property, plant and equipment outflow of 113 million. Purchases, and it's actually more additions and planted of biological assets, 242.6 million, and then some small other items. Dividends paid was 55.4 million, and that leave us with a positive cash balance at the end of the financial year of 113.3 million rand. We look then at the segment analysis. This chart shows the percentage contribution per segment in terms of revenue and EBITDA, contribution per segment. There was an increased contribution in revenue and EBITDA from the timber segment and a decrease in retail EBITDA as well as revenue. Normally the EBITDA contribution from timber is the biggest and also growing, followed by the retail and financial services segment, and the financial services segment is also growing in terms of contribution. If we look at the timber segment in a bit more detail, timber segment definitely the bright star. Revenue increased by 35.8%. EBITDA increased by 9.8%. This was driven by 7.9% increase in wood chip exports, especially to Japan. We've exported 684,000 tons compared to the 634,000 tons the previous financial year. Andre already mentioned that the expectation in the beginning of the year that we will export between 800,000 tons and 900,000 tons, especially because of the demand from the China markets and also the possibility to the Europe markets. Unfortunately, that didn't materialize because of weak economies in those two countries. There was also an improved local market timber sales. The total sales volume for the year, that includes the exports, increased by 5.3% to 1.5 million tons. The influencing factors of this timber segment was the weak rand that supported the export revenue as well as margins. Sales to the mining sector, however, came under pressure. Transportation cost eroded EBITDA margin because of the increases in fuel prices. The timbers, as I mentioned, already contributed really positively in terms of the results of timber. However, subsequent to 2023 financial year end, there was a fire at the NCT facility in Richards Bay, but luckily none of the stockpiles of TWK were impacted with fires. However, they were contaminated with some of the products from our neighbors. But Andre will mention it a bit further in detail in his presentation. If we look at the retail and mechanization segment, revenue decreased by 8.3% and EBITDA decreased by 78.9%. These results were negatively impacted by the performance of Constantia Fertilizer, but also by mechanization. There was a sharp drop in the fertilizer raw material prices throughout the year since March 2023, since our half-year results, and that really led to the significant cost price reductions, and it was just difficult to maintain positive margins because of the constant decline of the fertilizer prices. The fertilizer sales volume declined by 10.7% to 186,000 tons. That was due to lower sales volumes as farmers postponed their buying fertilizer, the expectation of potential further declines in the selling prices, and also the lower application rates from the farmers. Mechanization sales through our New Holland agencies decreased by 5.9%. The influencing factors, the major influencing factors of the retail and mechanization segment was a challenging fertilizer trading conditions and the mechanization sales that influencing also the health of this segment, and it was really driven by the lower sales to farmers, especially in the sugarcane industry. If we look at the financial services segment, also a bright star, revenue increased by 23.3%, EBITDA increased by 21.2%. This segment consists of two divisions. Firstly, the insurance division reported a 7.3% growth in short-term insurance premiums, which translated positively to 15.5% increase in commission income. There was also a 3.2% increase in total crop insurance premiums in this division. And then also the recent acquisition of EUM also performed well and actually better than our expectations. We look at the credit division of this segment, reported a decrease in net interest of 16.5%, mainly as a result of a decrease of 58.4% on production accounts placed on bridging facilities due to favorable conditions experienced from the farmers, So just to put that in perspective, the bridging accounts, normally we earn higher interest in that accounts, and if it is the total output in that line is lower, our net interest income is also lower. It's actually a very positive sign, although lower interest, but it just shows the health of our credit book. The production credit book grew by 13% and peaked at 916.7 million during the year under review. I think I need to mention as well that our credit book is really healthy. It is a constant focus to make sure we have good farmers on our book and also supported by good quality security. We look at the grain segment, revenue increased by 0.9%. It's really driven by commodity prices. EBITDA increased by 12.6%. That was mainly due to a solid performance by the grain marketing business, supported by marketing in a wider offset area, especially since the beginning of this financial year. The grain storage business received 11% less grain than the prior year. That was as a result of lower grain yields in the Mpumalanga region. The grain mill business was negatively impacted by high grain prices. However, the consumer demand for maize is stable. The Arrow Feeds business in Eswatini reported an increase of 1.6% sales volume and also contributed positively to the results. In conclusion, the negative impact of the fertilizer business unit was to a great extent negated by solid performance of the other segments. It really underlines the effectiveness and also the importance of our diversified business model, and that paves the way for stronger growth prospects, especially in the new financial year, but also ongoing. I think TWK have already proven our ability to succeed within the agri sector, and we remain focused on our strategy and will continue to evaluate the return on investments and will act in the appropriate manner where desired results is not achieved. We will continue to explore further cost efficiencies and also synergies, also opportunities to leverage on TWK asset base and also the infrastructure. Thank you. Andre?
Thank you, Eddie. If we can just look at the year ahead, that is in the past now. So we're looking at what's happening in the new year in 2024. I think, first of all, we believe that the macroeconomic and trading conditions will still be remaining challenging for us. If we're looking at the timber business, we expect some margin pressure due to international pulp prices that's declined. Also, commodity, the international pulp prices for the pulp side, hardwood, it was around about $800, and it also decreased to under $500. But at least in the last month, it increased again to around about $600 for hardwood pulp. And I think it's that's going to be putting pressure on our margin for export of our wood chips that we sell. Then also, EDF quickly mentioned it as well, is the fire that we had, or not, it's actually our neighbors in CT that had a fire in Richards Bay, where our export facility is, that has contaminated our stockpiles as well. And unfortunately, we were not able to sell that chips to our normal customers in the pulp industry, because the pulp industry is very specific of they have no carbon that's in that product, so they're not going to take it. But like it also mentioned, our values is to be resilient and to be innovative, and we already our marketing team is already sell that product to the bioenergy market, and that product is going hopefully to be moved in the next month or so. But unfortunately, at this stage, we for the last 2 months will not be able to operate there. It have an impact not on us as well, but also on the bark as well, and also on our farmers that at this stage we cannot take new logs to start chipping on that logs to export. But we are covered in that with our insurance, and there is a price difference in what we are going to export, but at this stage we are confident that the insurance will pay out the difference in what we're getting now for our stock than what we should have get, and also for the business interruption that we have at this stage. But we think we're still going to have a good year on the export side, and we're also looking at new markets, except from China, because China is still, the economy is still not running as it should. So we think we're not going to export to China this year, but the Japan markets is still very steady at this stage, and we don't think there's going to be a problem, but we're targeting some of the Europe markets that we be there, and also in India as well. Then on the retail and mechanization segment, we also expect a tough first half of 24. It is our customers that's going to be a little bit under pressure if you're looking at the interest rates, looking at the diesel prices, and also they have the El Nino at the back of their minds. They're not going to be spending unnecessary at this stage, especially on mechanization side. So, and that will definitely have an impact on our retail and mechanization if they are holding back on their expenditure. On the fertilizer side, Constantia Fertilizer, we think we are in a much better position than we were last year. Prices have stabilized and it's more on normalized levels where we were previous years. And we are focusing on efficient procurement and raw material management. That is an important part of the fertilizer business. And we have changed that model a bit there. And we think definitely in future, with this big spikes that happened, this is the biggest one that I know of in recent years. But still, we have changed our procurement and how we procure. Probably we're not going to have the big profits that we have in 2022, but at least we will also not have the downside that we have this year. So we think we're going to be a more stable Constantia Fertilizer with the things we have put in place in regards to procurement and the management of our raw material. Then on the financial services side, you can see that business is doing well, is growing well. And this year we also have more focus on growing our footprint in our financial services business as well. If you're looking at grain, I've mentioned El Nino, and that could be that we have a little bit of less rainfall and smaller crops. But naturally, it's more part of the northwest side of our country and the central side. In recent years or in the past, it didn't have such a big effect on our part where we operate in the southern side. So we still believe that we're going to have good crop and it won't affect us that much. In fact, last year we are down a little bit from our long-term yields that we normally have because we had too much rain and we had some problems with that. Then if you're looking at the rest of the business, I think I must say that the diversified revenue streams, once again, with good cash generation, allows us for a robust strategy, and also our extensive footprint, infrastructure, market share, and expert enabled us to maintain and expand our existing businesses. Also complemented by acquisitions with a focus on the agricultural value chain. I think that's what it looks like for us in the next year. If you're looking for the year for us, we believe that we can definitely change, especially in the retail and mechanization side, that we can outperform this year's results and more or less get we were the previous year. I've mentioned our values, just a quick look. We have our values, that's the acronym AGRI. The A stands for accountability, the G stands for growth trust, the R for resilience, and the I for innovation. And we have focused the last year specifically on resilience and also innovation. That is a big part of our values and values. If you look at our strategy is still focused on our stakeholders, our financial performance, our process excellence, as well as our people and our transformation. If we're looking at the focus of our stakeholders, we still strive to be the supplier of choice, the market of choice, achieving sustainable growth with our customers and our communities. In the focus on our financial performance, we strive to be the investment of choice through the creation of shared value, entrepreneurial spirit, commercial expertise, focused innovation, technology enablement, ongoing process optimization, to continue to deliver strong and sustainable growth. Process excellence, manage and optimize process excellence into effectiveness. In a focus on our people and transformation, we strive to be the employer of choice, ensure that the talented people in intelligent technology are the building blocks of our future success. Thank you very much for attending this, and you are welcome to ask us some questions.
Thank you so much, Andre and Eddie, for that. I'm going to hand over to the Finance Ghost and Mark Tobin to take you through the Q&A session.
Thanks, Vanessa, and thanks, Andre and Eddie, and welcome back to Unlock the Stock. Eddie, maybe this is one for you, or maybe Andre, I'm not sure, but I just want to talk on the financial services and insurance division. Is it, it's one of the really bright spots and growth areas within the business. Where do you think you are in terms of, I guess, penetration within your customer base? Is what we're seeing just kind of really scratching the surface at the minute in terms of, the products that you have? I know we talked on the last session, I think, about, there's potential to add in other products here, but if we just talk about the products that are there, I mean, how far into the customer base do you think you've kind of penetrated, or is this really just kind of at the nascent stage of growth for what could be for this division?
Thanks for that. Yeah, I think, like we already mentioned in our strategy, our focus is on our customers, and we've already proved that in the past that we are able to deliver on the needs of our customers, and we also do have the backing in terms of our financial structures to support our farmers. So yes, I really think that we've only started to scratch the surface, especially on the credit side. But we focus on good quality clients to make sure that we don't run into risk in terms of defaults. So it will only on-lend to farmers that we see that there's enough cash flows and also underlying securities. But there is definitely a need and opportunity for further growth. But we are currently also looking at how we're going to structure our financial services division in terms of the credit book to give us access to additional capital without the negative impact on our balance sheet. And hopefully we will be able to enroll that in the new financial year. Then in terms of insurance, the last couple of years, we've increased the footprint, and by acquisitions specifically. Currently, we are, like I actually mentioned it in one of the slides, that we constantly looking at new opportunities to unlock the value. There is a pipeline of new acquisitions in the insurance division, and we going to implement a new one or acquire a new one in January. And I think there's quite a pipeline on that as well. So it is a focus. And we will definitely see some good growth and revenue and profits from that segment.
And thanks, Eddie.
Hi guys, thanks for joining Unlock the Stock again, and to everyone who's come onto the call. Remember, you can send questions through to Mark or I in our direct messages, in our DMs. I actually also just want to touch on the financial services side. I think it's a question that we asked in the last Unlock the Stock with you as well, but I think it's always worth repeating and just understanding it properly. On your insurance business, are you only exposed to the premium income effectively, or do you take any form of underwriting risk whatsoever? And the reason I ask is, Suntime released results this week that made it pretty clear that premium growth is looking just fine in South Africa because obviously there's inflation and there's a lot of risk in operating here. But net underwriting margins are proving to be very problematic for short-term insurance. So I think just understanding your insurance business model a little bit, just for those on the call.
Yeah, thanks. So our business model in insurance is purely based on premiums and the commission income that we receive from that. We do have the capabilities, we've got the infrastructures, we've got the technology to support that. But no, we don't take any underwriting risk in terms of that division. It's purely commission driven.
Can I just can we just talk about the gearing levels, Eddie, as well? Sorry, we seem to be peppering Eddie with the questions here, but I think it has been coming down over the last few years. Is there a level that the board is trying to target that you would like to get to in the medium term, or is it just okay, we've got excess capital here, we're going to pay down a bit of debt, we've got a few new opportunities to potentially invest in, and maybe just talk to about that gearing level, because it is definitely on a downward trajectory over the last few financial years.
100%. I think it's firstly important to understand why our gearing ratio is potentially higher than other companies in the market, although it's not uncommon for agribusiness to have those levels of gearing. Our gearing did came down the last couple of years, especially the last 2 years, and that was because of a purposeful drive to decrease it, to be prepared for the increased cycle in interest rates. So yes, we do strive for a healthy level of gearing ratio. We will not be uncomfortable with a level of 150%, but we're constantly looking at new opportunities, but we do make sure that the underlying cash flow of that new businesses will be able to support our business, and if we increase the gearing, to be able to pay the debt and also the interest on that additional gearing. Like I mentioned earlier, the current pipeline of new acquisitions, there's actually a couple of them, also big ones, that will definitely increase our gearing ratios, but it's very positive investments also in the timber industry that will be able to support the higher levels of gearing. But we keep on focusing on it, and we will definitely, with this acquisition, see if we can support the acquisition with also paper in the market, but we will definitely also use the cash surplus from the sale of the businesses in the motor segment, and also the cash received from the solar business, the roof space business.
I'd like to bring out the motor segment, actually, so I'm glad you gave me a nice entry into that. I always think people pay the most attention in the Q&A, so I like to always bring to the front some of the more important strategic decisions that you guys have potentially made. So obviously selling the motor dealerships, that's a big one. I think it's worth maybe just touching on what was the thinking behind, getting out of that side of the business. Just some understanding, would you do it again? Is it a temporary thing? Was it just not a good strategic fit? Did you get a good price? I think, for people who just want to refer back to understanding exactly why that's happened in terms of that exit.
Okay, I'll get this one. Yeah, the last strategic session that we have spoken about it, and every year, like I also mentioned, we look at all our businesses, and first of all, we look at our core business and also the value chain within our core business. Where can we invest in? Where can we, be part of that value chain? And if we look at the motors division of our business, it's not really part of our core business. And I think even on Unlock the Stock, there was a question about how is motors part of our business? Is it part of our business? So that's the same questions we ask ourselves. And it is not really part of our core business. And also the returns we're getting for the capital employed is not what we would like. So it's better for us to rather utilize that capital somewhere else in the value chains of our core business and do some acquisitions there that we can get also better returns, and it's part of our core business, and we can have better returns on that capital invested there. So yeah, we're not selling it at any price. We still want to have a good price, but the decision is made that it's not part of our core business, and that we are looking to sell it, and we're going to sell it, but at a good price so that we can use that capital, as Eddie also already mentioned, that there is some acquisitions that we'll be looking at this stage.
Andrew, maybe a question we might just be going a little bit back maybe to first principles here, but in terms of the commodities that impacted the retail and mechanization segment of the business, if somebody is reading out there, or South Africa is expecting, makes it into mainstream media, I'll say, expecting a record grain harvest, or a record sugarcane harvest, or beef prices are kind of really gone off the charts. And the customer base that you're serving through the retail and mechanization division, if somebody's trying to kind of get a line of sight on, well, if grain is going good or sugarcane is going good, you're going to see the flow on impacts of that. Okay, maybe not straight away, but 3, 6 months, 9 months down the line, once the cash is in the door and they've got money to spend on upgrading equipment and other stuff for their operations. So maybe just in terms of what commodities you're kind of exposed to, I guess, if I can say that, even if it's kind of secondary.
Yes, I think TWK is a diversified company, so are our customer base. We are lucky that we are not only in a region where it's only grain or only sugarcane is part of where we are situated, but most of our retail outlets is not in the sugarcane belt, as I can call it. So we have sugarcane farmers, but the biggest part of our farming, our customer base, is probably still the grain side. We have our tree farmers that have their own plantations, so they are also part of it. And most of our farmers, they have a bit of everything. They have a bit of cattle, they have a bit of tree farming, and then also they have the grain farming as well. So I think that also helps us a lot at this stage. Like I also mentioned, maybe our tree farmers are a little bit under pressure because we are not buying any timber from them at this stage. So we cannot buy, because our facility in Richards Bay is not operational at this stage. So that puts them a little bit under constraint. But then they have other means of income, like the cattle and so on. So that makes it useful for us to have a diversified customer base also. And we're not only at one that some of the other agricultural companies have a lot of grain-only customers.
Okay, thanks.
Just to follow up to the car dealerships disposal question, and just the way you guys think about the strategy of the businesses you own. So obviously very return on capital based focus there, which is always nice to see. A lot of companies don't do enough of that. The one thing that does strike me about the TWK group is a lot of the businesses are relatively low margin structurally. So that makes them quite volatile. If something's a 4% like profit margin and it drops to 3%, it doesn't sound like a lot. Only 100 basis points had to go wrong, but your profits have moved 25%. So that does drive some of the volatility. Just in terms of when you look at the portfolio, would you consider, or would you try and find higher margin businesses to try and manage some of the volatility, or is it very much a return on capital metric that you use when assessing what you should and shouldn't own?
I think firstly we should remember that TWK do have a 85-year rich history, and there's some of the assets that's really part of our DNA and our history, and those type of assets we just need to manage as effective and efficient as possible, and that will be part of our value offering to our value customer base. And the only way to increase that profits is really through efficiencies and potentially try to increase the markets as well. In terms of new opportunities, we constantly look at how it can enhance the current business operations. There should be something, there should be synergies, there should be something where we think we can add value either through our current operations or through our markets that we've got. But critical for us is to make sure that it do increase our margins, but definitely also downstream to all the other business and more of a supporting structure as well, to make sure that at the end of the day it equate to an increase in return on total capital.
Maybe I can just add that we're looking at that value chain, and we look where is the higher margins in that value chain where we can play a role, and that's actually what we're doing. We're looking at some of those businesses that can enhance our profitability, and also, of course, we know we on agriculture and the margins is low, and we're looking at some of the value chains where we can get some higher margins.
Andre, maybe another first principles one for me, just on the timber business. Now this, I'm prefacing by saying that Transnet are going to sort themselves out in the next year, 2, 3 years or whatever. Just on your comment on the high fuel prices impacted the margins, trucking it down from where you guys are down to Richards Bay. Is it possible to rail it down there, assuming that there is actually rail capacity, or will the margins of the timber business also be affected? We know it's obviously international pricing where the rand is at, but if we see oil get back to $60 and the fuel price comes way down, that is actually going to have a material impact on the margins within the timber business, just given you're moving it all via road rather than rail.
Yeah, in the past, everything was almost moved on rail. Our whole facility in Richards Bay is actually built for rail, and we have the last 2 years we had to spend a lot of capital to increase the volumes that coming by road to accommodate the trucks and to get a turnaround times right. So we had to spend a lot of money to change the intake from the roadside. I can just tell you now, we are in constant negotiations with Transnet, trying to get rail back, and that we can operate on rail again. The difference, maybe I can give the example, is probably the best. If you're looking at, we can do it from Piet Retief to Richards Bay. It costs around about 100 to 105 rands less by railing it down than to send it down by truck. And it's a volume game, and 105 rands a ton is a huge difference, a lot of money that we can do better by rather using rail than sending it down by truck. But we constantly trying to negotiations and trying to get rail back that we can utilize it.
Well, let's hope we see some kind of turnaround in Transnet there for you, and our mining clients who've been on here as well have also bemoaned the current rail situation. And I'm sure the people who live on the N2 between Joburg and Durban / Richards Bay are probably not loving all the trucks going up and down either. N3, I should say. Apologies.
Yeah. And the N17 and the N3 is.
Yeah. I don't have any more questions on my side. Ghost, have you got any further ones on your side?
No, I think we're out of time. I think we can call it a day. Thanks, guys.
Yeah, thanks, Eddie. Thanks, Andre.
Thank you very much.
Thank you very much.
Thank you, Mark and the Finance Ghost. And thanks everyone who participated in Unlock the Stock today. And a really special thanks to Andre and Eddie for once again making time to support this platform. We hope that you've enjoyed the session, and if you want to listen to it again, just a reminder that it is on, it'll be on the Unlock the Stock YouTube channel. So we do encourage you to subscribe to it, and you'll be made aware of all the videos that we've loaded. So this concludes Unlock the Stock for 2023. Thank you to everyone who supported and attended the 16 sessions that we've had. We've profiled more than 20 companies, and we will be up and running again in February 2024. I can't believe that it is the end of the year. But once again, thank you, Andre and Eddie, for participating, for everyone who was on the session today, and yeah, to everyone who's just made this Unlock the Stock possible for 2023. Thank you very much, and goodbye.